What if I told you there's a pattern, a recurring warning shot that has predicted the decline of great nations for the last 2,000 years? A signal tied to the value of gold that flashed right before the decline of Rome, Spain, and the British Empire. Now, what if I told you this isn't just ancient history, that the same alarm bell is ringing again right now for the United States? If history is any guide, what comes next isn't a total mystery, it's a blueprint. For 2 millennia, a simple, brutal pattern has defined the fate of the world's greatest powers. It isn't just about the size of their armies or the brilliance of their leaders. It comes down to something much more fundamental, something you can hold in your hand. It's a story about money, real money, and the story often ends the same way. When an empire forgets what real money is, it starts to decay. The warning sign is often a sudden, violent repricing of gold, a surge, a frantic flight to the one asset that can't be created from thin air. This signal has flashed red before the decline of major world powers for centuries, and it's flashing again. In this video, we're not going to speculate wildly. We're going to look at the historical record. We'll trace this golden thread from ancient Rome to imperial Spain, from revolutionary France to the slow decline of the British Empire. We'll see how a similar pattern, the same fatal mistake, repeats itself, and then we'll turn to today. We'll look at the data, connect the dots, and understand why the recent explosive move in the price of gold isn't just another market rally. It's a historical echo. It is a warning. And for those willing to listen, it's a map of what might be coming. To understand the crisis we face today, we have to go back 2,000 years to the most powerful empire the world had ever seen, Rome. For the first 2 centuries of the empire, its lifeblood was a single coin, the denarius. When it was first minted, the denarius was a marvel of monetary integrity, almost 100% pure silver. Its value was intrinsic. A Roman soldier, a merchant, or a farmer knew exactly what it was worth. It was real money. And with this real money, Rome built an empire stretching from Britain to Mesopotamia. But empires are expensive. The cost of legions on distant frontiers, colossal monuments, and bread and circuses for the masses began to weigh on the imperial treasury. The empire's expenses started to outpace its income. Roman emperors, facing what we'd call a massive budget deficit, had a choice. They could raise taxes, which was unpopular. They could cut spending, weakening the military and angering the people. Or they could find a third way, a secret way to pay their bills without anyone noticing, at least not right away. They chose the third way. They chose to debase the currency. It began subtly under Emperor Nero around 64 AD. He was the first to realize that if you can't find more silver, you can simply create more coins from the silver you already have. The process was simple. The government would recall the old pure silver denarii, melt them down, and remint them with a small amount of a cheaper metal like copper. The new coins looked the same, but they contained less silver. Nero cut the silver content to about 90%. With this new money, he could pay for his lavish projects and keep the army happy, solving his short-term cash problem. He'd discovered the ancient equivalent of the printing press. But he had also committed the empire's original sin. He set a precedent his successors would follow with devastating results. Each subsequent emperor, facing their own wars and crises, found the temptation irresistible. Under Trajan, the denarius was down to 85% silver. Under Marcus Aurelius, it fell to 75%. Septimius Severus, who famously told his sons to enrich the soldiers and scorn all other men, slashed the silver content to just 50% to fund massive army pay hikes. To the average Roman, the effect wasn't obvious at first. It was a slow, creeping disease, but over time, people noticed. It took more of these new, lighter coins to buy bread or wine. This is the simple, immutable law of money. Bad money drives out good. People hoard the pure silver coins and spend the debased ones as quickly as possible. The economy was slowly being poisoned. By the middle of the 3rd century, during the imperial crisis, the situation spiraled. More than 20 emperors rose and fell over 50 years, often killed by the very soldiers they could no longer afford to pay with sound money. The government abandoned all pretense of integrity. By the reign of Gallienus, the denarius, once a symbol of Roman might, contained barely 5% silver. It was just a bronze coin with a deceptive silver wash. And what happened to gold? As trust in the official currency vanished, the wealthy fled to the one asset that couldn't be debased. By 265 AD, prices across the Roman Empire had skyrocketed by 1,000%. This wasn't just inflation, it was hyperinflation, a complete meltdown of the monetary system. The consequences were catastrophic. Trade ground to a halt. Why would a farmer in Egypt send his grain to Rome for worthless coins? The interconnected economy fractured into a primitive system of local barter. The middle class was wiped out, its savings erased by inflation. The fall of Rome was a complex event with many causes: invasions, political instability, plagues. But at its core, the engine of its destruction was financial. The empire rotted from the inside out, committing suicide by debasing its currency. The soaring price of gold wasn't the cause of the collapse, it was the fever chart, a clear signal that the patient was dying. It was a vote of no confidence in the entire Roman system. The story of Rome isn't an isolated event, it's a blueprint. Throughout history, this pattern has repeated itself with frightening regularity. An empire rises, expands beyond its means, and then turns to the siren song of currency debasement. Each time, the result is the same, and each time, a surge in the price of gold acts as a deafening alarm bell. Let's fast forward 1500 years to the 16th and 17th centuries. The world's dominant power is the Spanish Empire. Having conquered the New World, a torrent of silver and gold flowed into Europe. It seemed like a dream. Spain possessed the largest treasure trove in history. But this blessing was a curse. The sheer volume of silver pouring in created a problem they didn't understand: massive inflation. With more money chasing the same amount of goods, prices across Spain rose relentlessly. Instead of building real economic growth, the endless silver encouraged the crown to embark on ruinously expensive wars. When the flow of silver slowed, the Spanish government was trapped with enormous debts. They resorted to the same trick as the Romans, debasing their coinage. The result was a death spiral. Confidence in the currency collapsed. Just like the Romans, people hoarded valuable coins and spent the debased ones. This led to hyperinflation and a series of royal bankruptcies. The vast wealth of the New World was squandered, and the empire that had once dominated the globe slowly crumbled into a second-rate power. Now, let's jump to 18th century France. The monarchy was teetering on the brink of bankruptcy. In a desperate attempt to create money from thin air, the revolutionary government that seized power in 1789 issued a new form of paper money called the assignat, supposedly backed by confiscated church land. At first, the idea seemed plausible, but the temptation was too great. Faced with ever mounting deficits, the government couldn't resist printing more and more. The result was the first hyperinflation of the modern era. Public trust evaporated. People rushed to exchange the depreciating paper for anything of real value, especially gold and silver. The government tried to enforce its worthless currency with brutal laws, including the death penalty for refusing to accept it. But you can't repeal the laws of economics with a guillotine. By 1796, the assignat had lost 99% of its original value. The French financial system completely collapsed, leading to poverty, riots, and the chaos that ultimately paved the way for Napoleon Bonaparte to seize power. Once again, a government tried to print its way out of debt. And once again, the value of gold went to the moon, a silent testament to the utter failure of the paper experiment. Finally, let's consider a more recent and perhaps more relevant example: the British Empire. For over a century, the pound sterling was the world's undisputed reserve currency, but two devastating world wars left Britain financially shattered and massively in debt to the United States. The decline was slower than in Rome or France, but the pattern was similar. Britain's economic power was waning. In 1949, the government was forced into a massive devaluation, cutting the pound's value against the dollar by over 30%. Another devaluation followed in 1967. Each devaluation was an admission that the currency wasn't as strong as it once was. Central banks around the world, which had held pounds as their primary reserve, steadily lost faith and shifted their holdings to the new global hegemon, the US dollar. The story is always the same: military overreach, unsustainable debt, and then the fatal choice: currency debasement, a loss of public trust, a flight to hard assets, and a dramatic repricing of gold. This is the historical blueprint for the fall of an empire. And the question we must now ask is: has this process already begun for the United States? For the past 80 years, the world has run on the US dollar. The Bretton Woods Agreement made the dollar the world's reserve currency with a critical promise: it was convertible to gold at a fixed rate of $35 an ounce. This link was the foundation of the entire post-war global financial system. The dollar was as good as gold, but like the empires before it, America's ambitions began to outstrip its means. The Vietnam War and major domestic spending programs in the 1960s put immense strain on the US budget. The US began printing more dollars than it had gold to back them up. Foreign nations, particularly France, grew wary and began demanding their gold. US gold reserves started to dwindle. President Richard Nixon found himself in the same trap as Nero. He faced a choice: impose brutal austerity or break the promise. He chose to break the promise. On August 15th, 1971, Nixon announced he was temporarily suspending the convertibility of the dollar into gold. That temporary suspension is now over 50 years old. In that moment, the dollar became a pure fiat currency, backed by nothing more than the full faith and credit of the US government. That was the day money, as the world had known it, stopped being real. What were the consequences? Exactly what history predicted. Freed from the discipline of gold, there was no hard limit on government debt. The US national debt, around $400 billion in 1971, has exploded. As of late 2025, the US gross national debt has surpassed an almost incomprehensible $38 trillion. The rate of accumulation is accelerating, with the debt increasing by trillions in just months. This is modern currency debasement. Instead of clipping coins, the central bank creates new money electronically to finance deficits. The effect is the same. The value of every existing dollar is diluted. The dollar has lost around 90% of its purchasing power since it was untethered from gold. This isn't an accident. It is a direct consequence of the decision made in 1971. For decades, the world went along with it, but now the historical alarm bell is ringing louder than ever. The signal, as always, is the price of gold. Recently, something changed. Gold has begun a historic surge, rocketing upwards and recently breaking through $4,000 an ounce. This isn't a normal market move, it's a seismic event. This is the kind of surge that history warns us about. It is a global vote of no confidence in the fiat dollar system. And it's not just private investors. The most sophisticated financial players in the world, central banks, are leading the charge. For years, many central banks were net sellers of gold. Now they are buying it at a pace not seen in modern history. In 2022, 2023, and 2024, central banks collectively bought over 1,000 tons of gold each year. The pace of buying from 2022 to 2024 was roughly double the rate seen from 2014 to 2016. Who was buying? Nations like China, which has been steadily adding to its reserves, Poland, dramatically increasing its holdings due to geopolitical uncertainty, India, Turkey, Singapore. These are nations, not hedge funds, and they're sending a clear message. They are de-dollarizing. They are seeking refuge in the one asset that is no one else's liability, the one asset that has maintained its value for 5,000 years. A recent survey by the World Gold Council revealed that the vast majority of central banks expect to continue or increase their gold purchases. This is a structural, long-term shift. They see the astronomical US debt. They see the endless money creation. They see the same pattern that destroyed Rome, Spain, and France. And they are preparing for the endgame. The signal has been triggered. The surge in gold is not the cause of the crisis, it is the symptom. It is the fever chart of a global monetary system that is profoundly sick. It is a warning that the era of the fiat dollar's undisputed dominance may be coming to a violent end. When a reserve currency dies, it's never a peaceful event. The collapse isn't a line on a chart, it's a human catastrophe. The historical blueprint, from Rome to revolutionary France, shows a clear and brutal sequence of events. If the pattern holds, this is what history suggests we could expect. First, a crisis of confidence that feeds on itself. As more people rush out of the currency and into hard assets, its value plummets. This is the beginning of hyperinflation. It's not just prices going up, it's the value of money going to zero. Your life savings, your pension, it all risks being wiped out. The middle class, the bedrock of any stable society, is the first and greatest casualty. Weimar Germany in the 1920s provides the most chilling modern example. To pay its war debts, the government turned to the printing press. In early 1922, a loaf of bread cost 160 marks. By late 1923, it cost 200 billion marks. The economic chaos destroyed the German middle class and created the political vacuum that allowed extremist ideologies to take root. Second, the collapse of the currency paralyzes the real economy. Supply chains break down. As we saw in Rome, long-distance trade grinds to a halt, and the economy fractures into inefficient barter systems. Store shelves go empty. Shortages of essential goods become common, leading to desperation and a breakdown of social order. Third, this economic chaos inevitably leads to massive social and political unrest. When people can no longer afford to eat and their savings are gone, they take to the streets. The debasement of currency is ultimately a betrayal of trust between a government and its people. When that trust is broken so profoundly, the government's legitimacy comes into question. This can lead to riots, revolutions, and civil war. The imperial crisis in 3rd century Rome is a stark reminder of how monetary collapse leads to political disintegration. Fourth, for a global empire, the collapse of its currency means a rapid loss of international power. The ability to issue the world's reserve currency is an exorbitant privilege. It allows a country to buy real goods from the rest of the world and pay with paper it creates at will. When that privilege is lost, the empire can no longer afford its global presence. The decline of the British pound after World War II illustrates this perfectly. As the world moved away from sterling, Britain was forced to dismantle its empire. A currency collapse forces an empire to come home. So, how can one prepare? History also provides a clear answer. During every currency collapse, wealth doesn't just disappear, it transfers. It moves from those holding paper assets to those holding real assets. The first and most obvious of these is gold. Gold is the ultimate hedge against monetary chaos because its value isn't dependent on a government promise. This is why central banks are buying it in record amounts. They're following a 5,000-year-old playbook. In the modern era, a new potential hedge has emerged: Bitcoin. While gold is the time tested store of value, Bitcoin's defenders argue that its strictly limited supply, which can't be manipulated by a central authority, makes it a potential hedge against fiat currency debasement. However, its track record is much shorter and far more volatile than gold's. The choice between the ancient and modern store of value is a debate for another time, but the underlying principle is the same. In a world of collapsing paper currencies, survival means holding something real. The blueprint is clear: a crisis of confidence, hyperinflation, economic breakdown, and social unrest. This isn't a prediction. It is a summary of what has happened when similar patterns have occurred in history. The warning signs are here. We've journeyed through 2,000 years of history, from the marble halls of imperial Rome to the frantic trading floors of today. We have seen a similar story play out time and time again. A great power rises, overreaches, and succumbs to the temptation of creating money from nothing. It debases its currency, whether by clipping coins or with a digital printing press. Each time the public is told that this time is different. Each time the ending is painfully familiar. Currency debasement leads to a loss of trust. That loss of trust leads to a flight to real assets. And the undeniable signal of this mass exodus is often the same: a sudden, sharp rise in the price of gold. This isn't just a theory, it is a powerful historical echo. The soaring value of gold is the market's verdict on the health of an empire's currency. It is a vote of no confidence. The debasement of the Roman denarius preceded the collapse of their economy. The debasement of Spain's currency marked the end of its golden age. The hyperinflation of the French assignat birthed chaos. The slow devaluation of the British pound signaled the end of its global empire. Today, we stand at another such moment. For over 50 years, the world has run on a system anchored by a US dollar, backed by nothing but a promise. That promise is now being questioned. The US national debt is spiraling into territory from which no empire has ever returned. And now, the historical signal is flashing red. The recent explosive move in gold is not a fluke. It is the collective wisdom of the market and, more importantly, of sovereign nations, recognizing the end game is approaching. The unprecedented wave of gold buying by central banks is the most significant clue. They aren't just speculating, they are preparing for a world where the US dollar may no longer be the bedrock of the global financial system. This isn't about predicting the exact date of a collapse. It's about recognizing a pattern. It is about understanding that the path we are on has been walked before, and it has often led to the same destination. The Roman citizen hoarding a pure silver denarius and the modern central banker adding tonnage to their gold reserves are responding to the same fundamental stimulus. They are seeking shelter from the storm of currency collapse. History offers no guarantees, but it provides a clear and powerful warning. It shows that financial laws are as unforgiving as the laws of physics. The consequences of systemic currency debasement aren't a matter of debate. They are a matter of historical record. The signal has been sent. The surge in gold is the echo of falling empires. The only question is whether we will listen. If you found this journey through financial history valuable, and you want to keep learning how to understand the powerful forces shaping our world, make sure you hit that subscribe button and click the notification bell. In a world of increasing uncertainty, knowledge of history is the best map you can have. Join us as we continue to uncover the hidden truths of how money and the world really works.